Elon Musk, Warren Buffett, Jeff Bezos. Besides the obvious mountain of money, here's the thing they actually have in common. They pay almost nothing in income tax, and it is completely legal. By the end of this video, you'll understand exactly how a person can be worth over $100 billion and hand the government less as a percentage than the person who cleans their office. Let's get into it. I want to start with a number that sounds made up. Jeff Bezos, at one point the richest man alive, paid $0 in federal income tax in 2007, and he did it again in 2011. In one of those years, he actually claimed a $4,000 child tax credit, the same credit built for ordinary families. Warren Buffett is even cleaner. Between 2014 and 2018, for every $100 his fortune grew, he paid less than 10 cents in federal income tax. Not $10, 10 cents. Now, your first instinct is that this has to be some shady offshore fraud. It isn't. Every piece of it is written into the US tax code, in plain language, sitting there for anyone to read. Back in the mid-1990s, a law professor at USC named Edward McCaffrey was trying to explain to his students how the wealthy quietly sidestep taxes, and he boiled the whole thing down to 3 words: buy, borrow, die. For years, other academics thought it was too simple to be real. Then, a massive leak of IRS records showed it was exactly how the richest Americans operate. So let me walk you through all 3 steps. And stick around, because at the end, I'll show you what actually happens when a normal person tries this at home. Alright, first up, step 1, buy. The rich buy things that go up in value. Stocks, businesses, real estate. And then they do the one thing the entire trick depends on. They never sell. Here's why that matters. In this country, you don't get taxed when something you own goes up in value. You only get taxed on the gain when you sell it. That's called the realization requirement, and it is the reason the wealthy hold on for dear life. Think about what that does. A normal person earns a salary, and it gets taxed the moment it lands in their account, up to 37% at the federal level. A billionaire's net worth can climb by $10 billion in a single year, and the income tax on that growth is exactly 0. Because as far as the tax system is concerned, you haven't made a dime until you cash out. On paper, they get richer every single day. On the tax return, nothing happened. But that raises an obvious problem. If they never sell and their money is all locked up in stock, how does Jeff Bezos actually pay for the giant yacht? How do you buy anything if you refuse to touch your fortune? That is step 2. Next up, borrow. Instead of selling their stock, the wealthy walk into a bank and pledge that stock as collateral for a loan. And here's the second gift hiding in the tax code. Borrowed money is not income. When you take out a loan, you have to pay it back, so the government doesn't count it as earnings. No income, no tax. Let me make it concrete. Say you're holding $1 million in an index fund. You go to the bank and ask to borrow against it. A typical loan to value on something that stable is around 70%, so the bank hands you a $700,000 line of credit, while your million stays fully invested and keeps growing. You now have $700,000 in spendable cash, and you owe the IRS nothing on it. This is not a theory. Larry Ellison, the founder of Oracle, is the textbook example. He has pledged billions of dollars of Oracle stock to back his personal credit lines. At one point, a slice of his stake worth tens of billions. Elon Musk plays the same game. Tesla's own filings show he has pledged well over 238 million Tesla shares as collateral for personal loans. Now, the fair question, doesn't the loan cost something? Yes, there's interest. Right now, a large pledged asset line runs somewhere in the range of 6 to 8%. But compare that to the alternative. If a wealthy American simply sells the stock, they can pay up to 23.8% in federal tax on the gain. And in a place like California, once you stack state tax on top, you're pushing 30%. So the choice is, pay roughly 30% in tax one single time, or pay a single-digit interest rate per year, while your portfolio keeps climbing behind it. For them, that is not a hard decision. And a few years back, when interest rates were near 0, borrowing like this was practically free. The third step is the darkest one. Die. There's a rule in the US tax code called a step-up in basis, section 1014. When you die, the cost basis of everything you own resets to whatever it's worth on the day of your death. In plain English, the built-up gain simply disappears. Let me show you what that means with real numbers. Say your grandfather bought a stock for $50,000, and on the day he dies, it's worth $500,000. If he had sold it the day before he died, he'd owe capital gains tax on $450,000 of profit. But he didn't sell. He held it. He borrowed against it to fund his life, and he died still holding it. His heirs inherit that stock with a fresh basis of $500,000. They can sell it that same afternoon and owe $0 in capital gains tax. That $450,000 of profit, an entire lifetime of growth, is never taxed. The loans get paid off out of the estate, and the income tax system never got a single swing at any of it. Buy, so it grows untaxed. Borrow, so you can spend without selling. Die, so the gain is wiped clean and handed to the next generation. That is the whole machine. So how do we actually know this is what's happening and not just a thought experiment on a whiteboard? Because in 2021, the newsroom ProPublica got its hands on years of confidential IRS files on the richest Americans. The numbers were staggering. Between 2014 and 2018, the 25 wealthiest people in the country saw their combined fortunes grow by $401 billion. The total federal income tax they paid over that stretch came to $13.6 billion. Run the math, and that's about 3.4 cents of tax for every dollar their wealth grew. Now, to be fair, and this genuinely matters, that 3.4% compares their taxes to wealth growth, not to income. And the US has never taxed gains you haven't sold yet. Critics say the comparison is unfair, and technically they have a point. But that's kind of the whole punchline of buy, borrow, die. The entire strategy is built so that taxable income never really exists in the first place. The comparison looks unfair because the game itself is unfair. So the natural question, can a normal person actually do any of this? And here's the honest answer. A watered down version, yes. This is not locked behind some secret Swiss banker. Brokerages like Interactive Brokers, M1 Finance, and Schwab will lend against a regular investment portfolio, some of them with barely any minimum. And if you own a home, you already know the civilian version of this. A home equity line of credit is the exact same machine, just with your house as the collateral instead of stock. But here's the catch, and it's a big one. At the interest rates we're living with right now, call it 5 to 8%, borrowing to fund your everyday life rarely beats just selling. Why? Because you probably don't pay billionaire tax rates in the first place. A married couple with taxable income under roughly $99,000 pays 0% on long-term capital gains. Zero. So you'd be paying 6% a year in interest to dodge a tax that, for you, is already nothing. And there's one more thing nobody puts in the highlight reel. This machine comes with a self-destruct button. It's called the margin call. When you borrow against a portfolio and the value of that collateral drops below the bank's threshold, they call you. Add cash fast, or they start selling your positions, and they can sell without asking. Which means a market crash can force you to sell at the exact bottom, triggering the very capital gains tax you spent years avoiding at the worst possible moment. A few years ago, a fund called Archegos was running this exact playbook at maximum leverage. Its collateral dipped, the margin calls came, it couldn't pay, and the banks liquidated everything. Around $20 billion, gone in about 2 days. So no, this is not free money. And it's not magic. It's the tax code plus a loan, and both of them have teeth. Here's what I really want to stick with you. Everything I just described is legal. It's public. It's sitting in the tax code for anyone who bothers to read it. The rich don't have a secret vault. They just have a different instruction manual. And honestly, Buy, Borrow, Die is only chapter 1. Because when the truly wealthy want their fortune to survive not just death, but generations, they bolt one more structure on top. The trust. And if you want to go deeper on how the wealthiest families use trusts to stay rich for over a century, I made a video on exactly that.